Hi, I'm Joey Carroll, and today we're going to be discussing Zoetis. More specifically, should we lend money to Zoetis, and would they be able to pay us back? First of all, who is Zoetis? Zoetis is a pharmaceutical manufacturing company who specializes in vaccines and medicines for livestock and companion animals, such as cows, horses, fish, cats, and dogs. They formed in 2013 after splitting from Pfizer. Today, we're going to be looking at two other competitors in the pharmaceutical manufacturing industry, including Eli Lilly and Novartis. Now, what factors make Zoetis creditworthy? The areas that we're going to be focusing on today are revenues, profit margins, assets and liabilities, and ratio comparisons between Zoetis, Lilly, Novartis, and the industry median. First of all, let's look at revenues and our gross profit. This is the first three lines of our income statement. Revenue and sales, cost of sales, and the difference between those is our gross profit. Now, when we look at revenue and sales, we see that revenue has grown 3% between 2015 and 2016, and 9% between 2016 and 2017. This growth in profit is very encouraging to a creditor as we are. What's also interesting is that our cost of sales, net of assets, has gone down. Cost of sales lowered from 36% in 2015 to 34% in 2016, down to 33% in 2017, which led to a gross profit increase. Gross profit grew $195 million between 2015 and 16, and another $310 million between 2016 and 17. Now, our operating profits and net income also show very positive numbers. Our operating profit, or the profit after all operating costs and expenses are considered, grew 61% between the years 2015 and 2017. And the net income, the very bottom line, the amount that goes to our shareholders, grew 142% between 2015 and 2016, and then another 5% between 2016 and 2017. These are very encouraging numbers in seeing the health and growth of Zoetis. Next, we're going to look at the balance sheet and at the assets and liabilities. Now, when you're looking at the balance sheet for Zoetis, there's an overall consistency between all the assets and liabilities. So we're only going to look at two major movers. We're going to look at the cash and the long-term debt. As we see, our cash between 2016 and 2017 had an increase of $837 million. Our long-term debt, however, also had an increase of $485 million. Now, looking at that long-term debt, I believe it's important for us to see where that debt could have gone. Obviously, some may have ended up in cash, as we did have a cash increase. But if we also look at our property, plant, and equipment details table, we'll see that $116 million was spent on machinery, equipment, and fixtures. And then at the goodwill and intangible assets detail table, we'll see another $183 million was spent on goodwill through acquisitions and patents, both bought and created. Now, let's look at a few ratio comparisons between Zoetis, its competitors, and the industry median. First up, we're going to look at our current and quick ratio. These are both liquidity ratios that show assets over liabilities. The quick ratio removes the inventory. For the current ratio, we'll see that Zoetis runs a 3.85 in 2017, right at 3 at 2016, which is much higher than Lilly and Novartis, and slightly above the industry median. The quick ratio, again, shows Zoetis slightly above the industry median. What this means is that they are taking their assets and they are uh, doubling over or tripling over and almost quadrupling over the amount of liabilities that they've incurred. Another large area that we should look into is the net profit margin. As we see in both 2017 and 16, Zoetis had over 16% net profit. Lilly and Novartis ran at 10% and over 13%, respectively, but the industry median is only 0.86 of a percent. This shows the superior. This shows how superior Zoetis is from both its competitors and the industry. We should also look at the return on assets, as we looked at earlier with the current and quick ratio at assets versus liabilities. We can see how well the assets provided income. Return on assets in 2016 and 17 were above 10% for Zoetis. They were at 5.5% for Novartis and Lilly, and actually a negative percentage for the industry median. Now, we should also look at a few areas that we might want to look a little further into. We have the average collection period, the days of inventory held, and the debt to equity ratio. Now, when we look at the average collection period, compared to its competitors, it is significantly equal and slightly above the industry median. Now, the days of inventory held, again, it's right next to its competitor, but it is quite a bit over the industry median. The debt to equity ratio also is much higher in Zoetis than either of its competitors or the median of the industry at 3.81 and 4.1 versus 17 and 16, compared to under 1 in both competitors and 0.06 for the industry median. Now, should we open up a line of credit for Zoetis with these facts that we have just discussed? First of all, we see that growing profits and revenues over the last 3 years. We see that they are taking their money and putting them into assets, patents, acquisitions to grow the company in order to make more money and spend less money in the process, which raises the profit levels. They have a great asset to liability ratio. When they buy something, they earn more from what they purchase than what they borrowed. And they show much better performance than their competitors, especially when it comes to actual bottom line figures. So should we open up a line of credit for Zoetis? I believe that answer is yes. Thank you so much for your time.